My name is Jason Odom, and I'm joined today by my colleagues Aaron Brown and Geraldine Sundstrom to discuss PIMCO's asset allocation outlook. Aaron, starting with you, the global economy has moved from a late cycle to an early cycle environment in less than a year. How are you positioning portfolios today?
Looking out over the next year, we expect that corporate profit growth will accelerate and risk asset valuations will remain well supported given the collapse that we've seen in real rates over the past year. As a result, as we enter 2021, we're overweight risk assets, and we're now looking to take more cyclical risk in our portfolio to take advantage of the accelerating global growth that we expect this year.
Geraldine, turning to you, are there any other structural shifts that have occurred? And if so, what are the long-term implications for investors?
At PIMCO, we've been discussing the idea of secular disruptors for years now. The pandemic, as you said, been an accelerator of these trends in areas like technology or geopolitical tensions between the US and China. As we look forward to the recovery phase now, climate and sustainability are at the center of many recovery policy. Importantly, many of these secular structural shifts are still in the very early stage and could represent good investment opportunities, like in renewable energy, electric vehicle, or automation.
Aaron, can you elaborate on some of the key equity themes being expressed in portfolios today?
Sure. The recovery in activity and the ongoing improvement that we expect in corporate profits should be supportive for a rebound in cyclically exposed assets that have meaningfully lagged the market leaders like big tech since the market bottom in March. The global manufacturing recovery should benefit industries like industrials, materials, as well as semiconductors. And in addition, the focused fiscal measures coupled with an improvement in the labor market should benefit consumer durables as well as housing recovery themes. On a regional basis, we believe that select emerging markets and cyclically oriented regions like Japan should benefit.
Geraldine, what if the recovery hits a speed bump in 2021? How are you thinking about portfolio diversification and protecting against a downside scenario?
It is indeed a time to position portfolio for a fresh, brand new economic cycle, but significant near-term risk remains. So it is important to keep good diversifiers in portfolio. First, we believe that safe government duration will remain a good diversifier for portfolio. And certainly, in case of an adverse economic environment, US Treasury would have room to rally. However, yield levels are relatively low, and we need to broaden the scope of this duration exposure towards some higher quality emerging markets like bonds of the Chinese government or those of Peru. We also use real assets like gold or inflation-protected treasuries, given the fact that they could not only be a hedge in case of an economic weakening, but could also act as potential hedge in case of an inflation surprise. Last but not least, we also rely on some risk-off high-quality currencies like the Japanese yen. The bottom line of all of this is that one has to diversify the diversifiers.